Welcome, savvy viewers, to a topic that often raises eyebrows and sparks curiosity. How to make money with debt. While the notion of leveraging debt might seem counterintuitive at first, the financial world is full of strategies where judicious use of borrowed capital can pave the way for wealth creation. In this video, we're going to explore unconventional yet legitimate ways individuals and businesses can turn debt into a powerful tool for financial success. So, buckle up as we delve into the art of making money with debt and discover the potential that lies beyond conventional financial wisdom. Making money with debt involves strategic and informed decisions that can help leverage borrowed capital to generate returns. Investing. Consider using borrowed money to invest in assets that have the potential to generate a higher return than the cost of the borrowed funds. This could include stocks, bonds, real estate, or other investment vehicles. Real estate ventures. Leverage debt to invest in real estate, such as buying rental properties or engaging in house flipping. The appreciation of property values and rental income can potentially outweigh the interest paid on the borrowed money. Business expansion. If you own a business, strategically using debt for expansion can lead to increased revenue and profitability. This might involve investing in new equipment, expanding facilities, or launching new products or services. Entrepreneurial ventures. Use debt to fund entrepreneurial ventures. Many successful entrepreneurs have started businesses with borrowed capital, and if the venture succeeds, the returns can far exceed the initial debt. Stock market margin trading. Engage in margin trading in the stock market. This involves borrowing funds to buy stocks with the expectation that the returns will be higher than the interest paid on the borrowed money. Education and skill development. Invest in education or skill development using loans. Acquiring new skills or furthering your education can enhance your earning potential in the long run, potentially justifying the debt incurred. Arbitrage opportunities. Identify and take advantage of arbitrage opportunities where the cost of borrowed funds is lower than the return on the investment. This could include currency trading, interest rate differentials, or other market inefficiencies. Debt refinancing. Refinance high-interest debt with lower interest options. This can free up cash flow and potentially save money in the long term, allowing you to allocate funds more strategically. Leveraging debt to build wealth requires a careful and strategic approach. Strategic investments. Identify investment opportunities that have the potential to generate returns exceeding the cost of borrowing. This could include stocks, mutual funds, real estate, or other assets. Diversify your investments to mitigate risks and maximize potential gains. Real estate leveraging. Utilize debt to invest in real estate, but go beyond traditional property purchases. Explore strategies like real estate partnerships, where multiple investors pool resources to acquire larger properties, spreading both the risk and the potential returns. Entrepreneurial ventures with scale. Leverage debt for entrepreneurial endeavors that have the potential for significant scale. Consider business models that can quickly capture market share or disrupt industries, allowing you to repay debt and accumulate wealth more rapidly. Acquire cash-flowing assets. Focus on acquiring assets that generate consistent cash flow. This could include dividend-paying stocks, rental properties, or businesses with reliable revenue streams. The steady income can help service the debt and contribute to long-term wealth accumulation. Education for high-income skills. Invest in education to acquire high-income skills. This might involve taking courses, attending workshops, or pursuing advanced degrees in fields with high earning potential. The increased earning capacity can justify the initial debt incurred for education. Business expansion and innovation. If you own a business, leverage debt for strategic expansion and innovation. This might involve investing in technology, marketing, or research and development to stay competitive and increase the value of your enterprise. Explore private equity and venture capital. Consider investing in private equity or venture capital opportunities. These investments often require a higher level of risk tolerance but can offer substantial returns. Evaluate opportunities to participate in funding early-stage companies with significant growth potential. Tax-efficient debt structures. Work with financial professionals to explore tax-efficient debt structures. This may involve taking advantage of tax-deductible interest or using debt in a way that optimizes your overall tax position, enhancing your ability to build wealth. Debt recycling. Implement a debt recycling strategy where you consistently refinance existing debts to take advantage of lower interest rates or to redirect funds into new investments. Debt consolidation. Consolidate high-interest debts into a single, lower-interest loan. This not only simplifies repayment but also reduces the overall interest burden, potentially freeing up cash flow for other investments or savings. Peer-to-peer lending platforms. Explore peer-to-peer lending platforms to borrow directly from individuals or groups. These platforms often offer competitive interest rates and can be an alternative to traditional banking channels. Employee stock ownership plans, ESOPs, for businesses. Consider implementing employee stock ownership plans. Employees become partial owners through these plans, and the company can use debt to fund the purchase of shares. This aligns the interests of employees with the success of the business. Equipment financing. Businesses can leverage debt to acquire necessary equipment. This allows companies to invest in technology or machinery that can enhance productivity and competitiveness, ultimately contributing to financial success. Franchise financing. Individuals interested in starting a business can explore franchise financing. Many franchises offer financing options, allowing individuals to use debt to enter a proven business model with established support and brand recognition. Government grants and subsidies. Investigate government grants and subsidies that may be available for businesses. These funds can act as a form of debt that doesn't necessarily need to be repaid, providing a financial boost for growth and development. Credit lines for short-term needs. Businesses can establish credit lines to address short-term cash flow needs. This allows for flexibility in managing operational expenses and taking advantage of opportunities without resorting to long-term, high-interest debt. Invoice financing. For businesses with outstanding invoices, consider invoice financing. This involves borrowing money against unpaid invoices, providing immediate cash flow while waiting for customers to settle their bills. Strategic partnerships and joint ventures. Explore strategic partnerships or joint ventures where resources are shared. By collaborating with other businesses or individuals, you can pool funds and expertise, reducing the need for excessive debt while still achieving financial goals. Subscription-based models. Businesses can transition to subscription-based revenue models. This predictable income stream can provide a stable foundation for servicing debt and planning for future investments. Contrary to the common perception that debt is purely a financial burden, strategic utilization can transform it into a potent instrument for wealth creation. Financial intelligence. Develop a keen sense of financial intelligence. Understand not only the cost of debt but also the broader financial landscape. Velocity of money. Embrace the concept of the velocity of money. Use debt to circulate funds efficiently, ensuring that borrowed capital generates returns at a faster rate than the interest accrued. This accelerates wealth accumulation and compounds financial growth. Behavioral economics. Acknowledge the psychological aspects of financial decision-making. Be aware of behavioral economics principles, such as loss aversion and cognitive biases, to navigate the emotional challenges associated with managing debt effectively. Creative financing structures. Explore innovative financing structures. Consider convertible debt, profit-sharing agreements, or other non-traditional arrangements that align the interests of lenders and borrowers in unique ways, fostering mutually beneficial financial outcomes. Timing and economic cycles. Recognize the cyclical nature of economies. The art lies in leveraging debt during opportune times, such as economic upswings, to amplify returns. Conversely, adopting a conservative approach during downturns can safeguard against undue risks. Technological integration. Embrace technological advancements to optimize financial strategies. Utilize fintech tools for real-time analytics, automated budgeting, and investment tracking to enhance decision-making precision and adaptability in the fast-paced financial landscape. Environmental, social, and governance (ESG) considerations. Integrate ESG factors into financial decisions. A conscientious approach to debt can involve investments that align with sustainable and ethical practices, contributing not only to financial success but also to positive societal and environmental impacts. Dynamic risk management. Implement a dynamic risk management approach. Continuously reassess risk tolerance, adjust debt structures based on market conditions, and diversify investments strategically to navigate uncertainties and enhance the overall resilience of financial portfolios. Cross-asset strategies. Engage in cross-asset strategies that involve diversifying debt across different investment classes. This approach can mitigate risks and capture opportunities in various markets, optimizing the overall risk-return profile. Continuous learning. Cultivate a mindset of continuous learning. Stay curious about evolving financial instruments,
Investing in the stock market can offer several benefits. Potential for long-term growth. Historically, the stock market has shown the potential for long-term growth. Over time, the value of stocks has tended to increase, providing opportunities for investors to grow their wealth. By investing in well-performing companies, you can participate in this growth and potentially achieve significant returns. Diversification. The stock market allows you to diversify your investment portfolio. By investing in a range of companies across different industries, you can spread your risk and reduce the impact of any single company or sector underperforming. Diversification can help smooth out the volatility of your investments and enhance the stability of your portfolio. Ownership and share in profits. When you invest in stocks, you become a partial owner of the company. As a shareholder, you may have the opportunity to benefit from the company's success in the form of capital appreciation and dividends. If the company performs well, its stock price may increase, allowing you to profit from selling your shares at a higher price. Dividend income. Many companies distribute a portion of their profits as dividends to shareholders. By investing in dividend-paying stocks, you can earn a regular income stream in the form of dividends. Dividend income can be particularly attractive for investors seeking passive income or those who want to supplement their existing income. Liquidity. The stock market provides a high level of liquidity, meaning that you can easily buy and sell stocks. Unlike some other types of investments, such as real estate or private equity, stocks can be bought or sold quickly, allowing you to access your funds when needed. This liquidity can provide flexibility in managing your investment portfolio. Accessibility and convenience. Investing in the stock market has become increasingly accessible to individual investors. Online brokerages and investment platforms offer user-friendly interfaces, allowing investors to trade stocks and manage their portfolios with ease. This convenience enables investors to participate in the market from the comfort of their own homes or through mobile applications. Inflation hedge. Investing in stocks can provide a potential hedge against inflation. As the prices of goods and services rise over time, companies may increase their prices and generate higher revenues. This can lead to increased profitability and potentially higher stock prices, protecting the purchasing power of your investment against inflation. It's important to note that investing in the stock market carries risks, including the potential for loss of capital. Stock prices can be volatile, and market fluctuations can affect the value of your investments. It's advisable to conduct thorough research, diversify your portfolio, and consider your risk tolerance and investment goals before investing in the stock market. Consulting with a financial advisor can also provide valuable guidance tailored to your specific situation. When it comes to passive income opportunities in the stock market, here are some popular options to consider. Dividend stocks. Dividend stocks are shares of companies that distribute a portion of their earnings to shareholders as regular dividend payments. By investing in dividend-paying stocks, you can earn a consistent stream of passive income. Look for companies with a history of stable dividends and consider diversifying your holdings across different sectors to minimize risk. Dividend ETFs are mutual funds. Exchange-traded funds, ETFs, or mutual funds focused on dividend-paying stocks can provide diversification and convenience. These funds pool investments from multiple investors and invest in a portfolio of dividend stocks. By owning shares of the fund, you can earn passive income from the dividends generated by the underlying stocks. Real estate investment trusts, REITs. REITs are companies that own, operate, or finance income-generating real estate. By investing in REITs, you can earn passive income through dividends paid out by the REITs. REITs can provide exposure to various types of real estate, such as residential, commercial, or industrial properties, without the need to directly own and manage properties. Peer-to-peer lending platforms. Some online platforms allow you to participate in peer-to-peer lending, where you lend money to individuals or small businesses in return for interest payments. While this is not directly related to the stock market, it can be an alternative source of passive income. Index funds or ETFs. Investing in broad market index funds or ETFs can be a passive way to earn income from the stock market. These funds track a market index, such as the S&P 500, and aim to replicate its performance. By investing in these funds, you can benefit from the overall growth of the stock market while minimizing the need for active management. Covered call options. Covered call options involve selling call options on stocks you already own. By doing so, you earn income from the premiums received for selling the options. This strategy is considered relatively low risk if implemented correctly, but it does require a good understanding of options trading. Royalty trusts. Royalty trusts are investment vehicles that own and operate income-generating assets, such as oil, gas, or mineral reserves. They distribute a portion of the income generated by these assets to investors in the form of dividends. Investing in royalty trusts can provide a passive income stream based on the production and prices of the underlying resources. It's important to note that while these opportunities can generate passive income, they still require initial research and ongoing monitoring. Additionally, the stock market carries risks, so it's crucial to diversify your investments, conduct thorough due diligence, and consider seeking advice from a financial professional to align your investment choices with your financial goals and risk tolerance.
Here are 10 ways to make your money work for you. Invest in stocks. Investing in stocks allows you to participate in the ownership of companies and benefit from their growth and profitability. Over time, well-selected stocks can provide capital appreciation and dividends. Bonds and fixed income investments. Bonds are debt instruments issued by governments and corporations. Investing in bonds can provide regular interest payments and return of principal at maturity. Fixed income investments, such as bond funds or treasury bills, offer stability and consistent income. Real estate investment. Real estate can be a valuable long-term investment. You can invest in rental properties, commercial properties, or real estate investment trusts, REITs, to earn rental income and benefit from property appreciation. Peer-to-peer lending. Peer-to-peer lending platforms connect borrowers with lenders, allowing you to earn interest on your loaned funds. This investment option involves higher risk but can offer attractive returns. Dividend investing. Dividend-paying stocks or dividend-focused funds can provide a steady income stream. Dividends are periodic payments made by companies to shareholders as a portion of their profits. Mutual funds and index funds. These funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. Mutual funds are actively managed, while index funds aim to replicate the performance of a specific market index. Exchange-traded funds, ETFs. ETFs are similar to mutual funds but trade on stock exchanges. They offer diversification and the ability to trade throughout the day. ETFs can track indices, sectors, commodities, or other asset classes. Start a business or invest in a business. Entrepreneurship can provide an opportunity to generate income and build wealth. Starting your own business or investing in an existing one can lead to financial success if done strategically. High-yield savings accounts. While not a high-risk investment, high-yield savings accounts offer higher interest rates compared to traditional savings accounts. They provide a safe place to park your money and earn some passive income. Education and skill development. Investing in yourself through education, training, or skill development can increase your earning potential and open up opportunities for career advancement or entrepreneurial endeavors. Remember, each investment carries its own risks and rewards, so it's essential to conduct thorough research, diversify your portfolio, and consider your risk tolerance and financial goals before investing.
Today, we embark on a journey to uncover the smartest ways to build wealth through strategic investments. In a world filled with financial opportunities and choices, navigating the path to prosperity requires insight, strategy, and a commitment to long-term success. Whether you're a seasoned investor or just beginning to explore the world of wealth creation, this video is your guide to making informed decisions and building a robust financial future. So, let's dive in and discover the secrets to intelligent wealth building through investment. Building wealth through investing requires a thoughtful approach and a long-term perspective. Diversify your portfolio. Spread your investments across different asset classes, stocks, bonds, real estate, etc., to reduce risk. Diversification helps protect your portfolio from the impact of poor performance in any single investment. Set clear goals. Define your financial goals, whether they are short-term, e.g., buying a house, or long-term, e.g., retirement. Tailor your investment strategy to align with your specific goals and time horizon. Invest for the long term. Long-term investments tend to yield better results and help you weather short-term market volatility. Compounding can significantly boost your wealth over time. Emergency fund. Before diving into investments, establish an emergency fund to cover unexpected expenses. Regularly contribute. Consistently contribute to your investment portfolio, even if it's a small amount. Take advantage of employer-sponsored plans. Contribute to retirement plans offered by your employer, such as 401ks or similar plans. Employer matching contributions can amplify your savings. Tax-efficient investing. Consider tax-efficient investment strategies, such as using tax-advantaged accounts like IRAs or 401ks. Reinvest dividends. Reinvesting dividends allows you to benefit from compounding and can accelerate the growth of your investment portfolio. Stick to your investment plan and resist the temptation to make impulsive changes during market volatility. Review and adjust. Regularly review your investment portfolio and adjust it based on changes in your financial situation, goals, and market conditions. Warren Buffett, one of the most successful investors of all time, has shared several pieces of advice that can be valuable for anyone looking to invest and build wealth. Here are some key principles inspired by Buffett. Invest in what you understand. Buffett advises investors to stick to areas they are familiar with. Don't invest in businesses or industries you don't understand. Long-term perspective. Buffett is known for his long-term approach to investing. He suggests thinking of stocks as businesses and holding onto them through market fluctuations. Margin of safety. Buffett emphasizes the importance of a margin of safety. Invest in companies that are selling below their intrinsic value to provide a buffer against unforeseen risks. Quality over quantity. Buffett prefers quality businesses with a competitive advantage. Look for companies with strong and sustainable economic moats. Cash flow is king. Buffett values companies that generate consistent and strong cash flows. Positive cash flow is crucial for the long-term success of a business. Management matters. Buffett places a significant emphasis on the quality of a company's management. Invest in businesses with honest, competent, and shareholder-friendly management. Be fearful when others are greedy, and greedy when others are fearful. This famous Buffett quote highlights the importance of contrarian thinking. Avoid following the crowd and consider opportunities when others are pessimistic. Stay rational and avoid emotion. Buffett advises against making investment decisions based on short-term market fluctuations or emotional reactions. Stay rational and focused on long-term fundamentals. Continuous learning. Buffett is known for his voracious reading habits. Keep learning and stay informed about the businesses you invest in and the broader economic environment. Holding cash is a position. Buffett doesn't hesitate to keep cash on hand if he can't find attractive investment opportunities. Patience is a virtue in investing. Avoid market timing. Buffett discourages trying to time the market. Instead, focus on the quality of the businesses you invest in and their long-term prospects. Frugality and simplicity. Despite his immense wealth, Buffett is known for his frugal lifestyle. Live below your means, and avoid unnecessary expenses. Remember that while Buffett's principles can provide valuable guidance, each investor's situation is unique. It's important to tailor these principles to your own financial goals, risk tolerance, and investment horizon. Here are 30 investment tips to help you grow your wealth. Set clear goals. Define your financial goals and align your investments with these objectives. Diversify your portfolio. Spread your investments across different asset classes to reduce risk. Educate yourself. Continuously learn about different investment options, market trends, and financial strategies. Long-term perspective. Think of investing as a long-term endeavor to benefit from compounding. Emergency fund. Establish an emergency fund to cover unexpected expenses and avoid liquidating investments during emergencies. Regular contributions. Consistently contribute to your investment portfolio, even if it's a small amount. Risk tolerance. Understand and assess your risk tolerance before making investment decisions. Stay informed. Stay updated on economic trends, global events, and factors that may impact your investments. Take advantage of tax benefits. Utilize tax-advantaged accounts and investment strategies to minimize tax liabilities. Reinvest dividends. Reinvesting dividends can accelerate the growth of your investment portfolio. Review and adjust. Regularly review your portfolio and adjust it based on changes in your financial situation and goals. Quality over quantity. Focus on quality investments with strong fundamentals rather than chasing quantity. Avoid market timing. Trying to time the market can be challenging. Focus on a disciplined investment approach. Understand fees. Be aware of the fees associated with your investments and seek cost-effective options. Emergency fund. Prioritize building an emergency fund before aggressively investing. Seek professional advice. Consider consulting with financial advisors for personalized guidance. Stay disciplined, stick to your investment plan and avoid impulsive decisions based on short-term market fluctuations. Cash flow analysis. Consider investments with positive and consistent cash flows. Invest in yourself, enhance your skills and knowledge, as your ability to earn is one of your most valuable assets. Monitor economic indicators. Keep an eye on economic indicators to assess the overall health of the economy. Patience is key. Be patient and avoid making decisions based on emotions or short-term market movements. Evaluate debt levels, manage debt wisely and avoid high-interest debt that could erode your investment returns. Stay liquid. Maintain some liquidity in your portfolio for opportunities and unforeseen circumstances. Regularly rebalance. Periodically rebalance your portfolio to ensure it aligns with your risk tolerance and goals. Network and learn. Engage with other investors, attend seminars, and participate in online forums to expand your knowledge. Consider global diversification. Explore opportunities for international diversification to reduce country-specific risks. Invest in index funds. Consider low-cost index funds for broad market exposure and diversification. Be realistic. Set realistic expectations for returns and avoid overly optimistic assumptions. Monitor tax implications. Be mindful of the tax implications of your investment decisions and plan accordingly. Stay adaptable. Be open to adjusting your investment strategy as your financial situation and market conditions evolve. Remember that investing involves risk, and there are no guarantees. It's essential to tailor your investment strategy to your individual circumstances and consistently reassess it as your financial situation and goals change over time. Here are 20 quick ways to potentially turn your money into a big investment. High-yield savings accounts. Explore savings accounts with higher interest rates to maximize returns on your cash. Peer-to-peer lending. Consider peer-to-peer lending platforms where you can earn interest by lending money directly to individuals. Real estate crowdfunding. Invest in real estate through crowdfunding platforms, allowing you to diversify with smaller amounts. Side hustles. Use your skills to start a side business or freelance work to generate additional income for investment. Education and courses. Invest in educational opportunities to enhance your skills, potentially leading to higher income or entrepreneurial ventures. Dividend stocks. Focus on stocks with a history of paying dividends to generate regular income. Cryptocurrency. Explore the potential of investing in cryptocurrencies, but be aware of the associated risks and volatility. High-growth stocks. Consider stocks of companies with high growth potential, though be mindful of the associated risks. Precious metals. Invest in gold, silver, or other precious metals as a hedge against inflation. Collectibles and art. Invest in valuable collectibles or art pieces that may appreciate over time. High-interest corporate bonds. Explore corporate bonds with higher interest rates but carefully assess the associated risks. Foreign exchange, forex, trading. Engage in forex trading with caution, understanding the risks and potential rewards. Options trading. If you have experience, explore options trading strategies to leverage your capital. Start a business. Consider starting a small business or investing in a business venture that aligns with your expertise. High-yield ETFs. Invest in exchange-traded funds, ETFs, that focus on high-yield assets for potential income generation. Renewable energy investments. Explore investments in renewable energy projects or companies contributing to sustainable practices. Real estate flipping. If you have expertise, consider buying and renovating properties for potential profit. Foreign real estate investments. Explore real estate opportunities in emerging markets for potential high returns. Micro-investing apps. Use micro-investing apps to automatically invest small amounts of money in diversified portfolios. Socially responsible investing. Consider investments in companies aligned with your values and principles for long-term growth. Always conduct thorough research and, if needed, seek professional advice before pursuing any investment strategy. Additionally, be aware of the risks associated with each investment option and tailor your approach based on your risk tolerance and financial goals. As we conclude our exploration into smart ways to build wealth through investments, we hope you found valuable insights that will empower your financial journey. Remember, building wealth is not a sprint but a marathon, and the decisions you make today can shape your financial destiny tomorrow. If you enjoyed this video, don't forget to like, share, and subscribe for more content that empowers you on your path to financial success. As always, make informed choices, stay disciplined, and may your investments pave the way to a prosperous future. Thank you for joining us at Smart Wealth Education. Until next time, happy investing.